Hi, my name is Sean Carr, and I'm with Logistics Insurance Advisory, and I'm here with Craig Dancer from Marsh. Craig is the transportation practice leader for Marsh, and we're here today to talk about structured excess programs. So first off, Craig, thank you very much for joining us today. Why don't you introduce yourself, and we'll get this thing started.
Terrific. Sean, thanks a bunch for having me. And Craig Dancer, transportation practice leader for Marsh. I've been working at Marsh for over 25 years, and for the most of my career, I've been in the transport space. So super excited today to introduce this concept to your audience.
So, Craig, we've worked on a couple accounts together, and I've certainly seen this concept. But why don't you just take a little time and talk about what is a structured excess program?
You bet. So a structured excess program really is an alternative way of buying insurance excess of a primary auto liability placement. So generally, most carriers are buying $1 million, sometimes $2 million. And to purchase additional limits in a traditional marketplace, you're buying an amount of limit on a single year basis in that excess layer. And really that is a one and done type of situation where essentially the market has more or less taken that pricing for those excess layers and really doesn't underwrite the individual client themselves. So what structured excess really does offer as an alternative is for motor carriers to really take a little bit of variability on their own balance sheet, but in exchange for that, they're getting a significant discount and they're locking in a program for over 3 years. Generally speaking, these policies will sit excess of a 1 million, 2 million primary. They can be put into a 5 million layer, 5 million excess of 5 million excess layer. But really the key elements of these programs is that they're multi-year in nature, the rates are fixed. And one of the key differences which is why the market can price these a little more competitively, is the fact that they are aggregated limits. So what aggregated limits allows an underwriter to do is to say, hey, I know my quantum of risk. I'm putting out 10 million or 15 million of limit. I'm looking at the client's actuarial historical losses, and I can marry that up with the probability of that loss pick to really, how does that influence the ability for me to price the risk more competitively? And since I know my worst case scenario, I can price it with a discount versus the traditional market, which is really just taking a gamble on 1 year at a time, unlimited liability effectively, and saying, hopefully this year I won't get blown up by a bunch of bad losses. So in general terms, they're all multi-year, they are aggregated. There's some variability on the premium that really can benefit the client, because essentially if you have a client that's doing everything right, they can benefit from a program that they would be entitled to get some money back. Whereas if you're buying a traditional program, you can run clean for 5 years and that insurance company is very, very happy about that, but you're not going to get any money back out of that. So that's at a 30,000 foot, those are the key differentials between a structured program and a say a traditional excess auto liability program.
So why has this product emerged? I mean, I know that the excess market has really been hit with the nuclear verdicts, and I think it's difficult for underwriters to really kind of put a box around that risk. Is that the real reason why this product has emerged?
It really is, Sean. I mean, if you look back, starting say in 2016, 17, as you say, the market really started seeing a lot of this adverse loss development. So it wasn't just nuclear verdicts; it was just simply claims that were reserved at some low amount that in 3 or 4 years' time were really blowing through all the actuarial curves. So severity became a huge problem, and we all talk about social inflation and all those sorts of issues, but that really did impair the market. So when you think about the markets that are sitting sort of excess of those primary auto layers in 1 millions and 2 millions, those are the markets that were truly impacted by these adverse loss experience. So what underwriters basically said is, okay, Mr. Trucker, it's not a matter of if you're going to have a claim, it's when you're going to have a claim that's going to hit my layer, whether it's million or 2 million or 3 million in excess. So essentially what happened was underwriters over the last 7 years really just took a position of saying, okay, if I give you a 2 million limit over 1 million, you know what? You might never have had a loss in that layer, but I know the industry has had lots of them. So what I'm going to do is I'm just going to simply price it on the basis that if you're on the if you're doing everything right, maybe I'll give you, a premium that might equate to a one loss in every 5 years that will deteriorate my limit. Or on the other side, you might be in a situation where they just think you're going to have a loss every year and just price that limit based on what they expect your losses to be. So on a structured deal, you're really taking that sort of industry mindset away from the underwriter. And the underwriter is really looking individually at a risk and saying, hey, look, if you think you're doing really everything right and you haven't had any claims and you likely won't have any claims on a go forward basis, then you know what? I can price that 2 million excess program X of your 1 million primary much more competitively on the basis that I will give you a big discount going into it. Now, if you have claims, then the variability comes in where basically that 3-year program premium would adjust, but it's adjustable on the basis that there's a cap. So you always know going into the program what your deposit amount is, what the benefit of what you get back is prescribed, and you also know the downside. Like, okay, if you do have a number of claims that hit the layer, you also know what your downside is. So you know what your minimum cost is, you know your maximum cost, you know your expected cost. It's 3-year deal. So even if you have a bad blowout in the first year, you still have insurance for years 2 and 3. And the other beauty is if you're on a traditional 1-year deal, if you have claims that go into that layer on a 1-year deal, you're going to pay for that on the next renewal and the renewal after that. And it doesn't matter whether you shop your insurance or whether you stay with the same insurance company that you're with, you will pay for that claim ultimately. And what we tend to find, Sean, which is really fascinating, is that when we look at these deals on a 3-year basis, so basically you just run, okay, here's 3 years of guaranteed cost insurance. Here's my 3-year deal. Here's my best case, my worst case scenario as far as total cost. And no matter what you do, if you run losses against a traditional deal versus losses running through a structured deal, 9 times out of 10, even with all the losses that are running through a structured deal, you're going to pay significantly less in premium than if you were just rolling the dice in the guaranteed cost market. So so again, some people fear like, well, what if I have claims? Well, if you have claims, you actually know what you're going to pay versus if you have a claim in a traditional insurance market, you have no idea what you're going to pay next year until you get to the renewal.
So Craig, you and I worked on a deal together, and it was a company with roughly 50 million of revenue. And the renewal for the, let's call it 6X01 was 2.2 million. And we were able to get the 4X01 for 833,000. Normalizing that's about a 44% savings over normal pricing. So I just thought for the audience to kind of understand what the value here might be is you not only, as you said, you normalize what you think those costs are going to be, but you also significantly reduce the amount of money that's going out the door.
Right.
So there's not too many people that can say they saved 44% in this excess market environment, unless we did something creative like the structured program.
That's right, Sean. And really that's pretty much exemplar of what we see on every deal that we do on a structured basis, is that there's generally, 40 to 50% savings on the deposit versus what a traditional insurance program looks like. And as I said, your client had no historical claims in the layer. There was no expectation that there would be claims going forward. But the problem is the market believes that it doesn't matter how good you are, you're going to have the claims. So they're going to just build in the fact that you're in the industry and you're just like everybody else in the industry. You might be on a slightly lower spectrum of potential, but you're still in that industry. So they're just going to penalize you with what's going on across their own book. So these are deals that, again, really can help. And it from a size of fleet standpoint, this is not just, for the big guys. I mean, this is something that is utilized more or less across the industry when you get to a point where you look at your individual pricing on any one of those layers and you say, look, if I'm paying more than say $400,000 or $500,000, then you would be a prime candidate to look at a structured program.
Thanks, Craig. I think that's really good information. And we're not really going to dive into this in an exhaustive fashion because we're just looking to kind of get the concept out there.
Sure.
But let's talk about market access. How would a client get into the market? How would they what would be their best way to access this type of product in the marketplace?
Right. Well, obviously I work for Marsh, so I'll have to, obviously, use our own platform as an example. But having said that, I mean, Marsh, obviously we have global scale. So, we have operations in London, Dublin, Bermuda, Zurich that really focus in. We have dedicated people that work directly with markets in the trucking space. So we've actually been the market pioneers in terms of these types of products. And I would say if you go back 6-7 years ago, there was probably one market that would write this type of program. It was Aegis Syndicate out of London. Since then, we've done a lot to really develop that London and Dublin marketplace. I mean, so between our Bowring operations, which is our UK, Dublin, and European operations, as well as Guy Carpenter. So Guy Carpenter is our reinsurance sister company. So the Guy Carpenter facility that we use in Dublin has access to about 3 or 4 markets, and then Bowring has opened up about 7 or 8 markets in the UK and Dublin that write these structured programs. So that's where I was saying earlier, I mean, we can now write deals, particularly on the larger guys. Yeah, we're writing 45, 50 million of structured layers across their portfolio. We've probably put over 100 million of written premium just on structured deals. I mean, we're obviously Marsh does $1 billion just on transportation business here in the US, placement wise, but specific to this product, we're doing over 100 million in this space. And I would say, we handle, roughly 30% of the top 25 motor carriers. And then obviously we've got a very large commercial middle market book. And between our MMA platform and our Marsh platform, I would say probably 80% of our truckers that we write as clients, we've moved from, over the last 6 years, from a first excess auto layer, whether that's a 3 million excess of a 2 million primary, or 5 million excess of 5 million, or layering up. I would say about 80% of our trucking book now has at least one layer of structured capacity. So it's been something that we've focused heavily on this area, because again, we got tired of looking at the traditional market and saying, well, I could look across my book at one point and say, there's really not much variability going on, even though all these underwriters say they individually underwrite a risk. They don't. I mean, there's some small little variability, but for the most part, they're just taking a book approach.
Can I safely say that Marsh is suggesting in the marketplace space, they'll do the analytics for the trucking firm, and they'll be able to give guidance to both the underwriter and the motor carrier to say, this is what we think it would be based on the amount of deals that you've done?
Yeah, absolutely. So great point, Sean. I mean, you can't with these, every single one of these programs is unique. So I can't say that the program we did for your client, I can look across our book. It's not going to be the same as any other clients. Every client is individually underwritten, and we do that. So you can't take a traditional approach of just putting a submission together and tossing it in the market and hopefully something interesting comes back. No, you got to sit there and actually write up the deal. So we are writing up the deal in our UK and Dublin desk. So I work with those operations, and we sit down, we do all the analytics, and then we come to a point of saying, okay, here's the layer that we're going to do, or the layers that we're going to write, and here's the specific terms that we're going to put on that deal. And so essentially we work with the underwriters, we give them that deal, and then they have their actuaries effectively validate our work. And really what that helps in the underwriting process, again, it goes back to scale, why we're able to do so many of these deals, because when we put a deal together, 90% of the time we're able to bind that deal. So when you approach the market, whether it's in London or there's a couple markets here in the States, they know when Marsh is coming to them with a deal, that's a solid deal. It's not somebody out there just saying, oh, well, let me feel this out and I'm going to compare it against 16 other deals, because there are limited resources. So that's how we've been so successful in really dominating the market with this particular type of structure.
So that's a big difference than what a lot of particularly middle market motor carriers might be approaching the marketplace. They might be looking for quotes coming in, but I think it's important to point out that this is more a consultative product, that you would work with an individual broker to go to the markets, because it's such a specialty area. It's not like, there will be hundreds of companies that'll quote. There might only be a handful.
That's right. And you're right, it is a consultative process. So what we try to do is, as you saw yourself, we'll come in and we'll do a pro forma. So we'll put together what the deal structure would look like. We'll run through, okay, here is what, based on your existing program structure, and let's forecast out 3 years of what that might look. And then we'll overlay that and compare it to, here's a pro forma on how a structured approach might look. And we'll run loss scenarios through each one of the, whether it's guaranteed cost or running through a structure program. So you can get to the point where you can say, okay, I'm feeling pretty comfortable about this particular approach. And so it does take a little bit more explanation, because obviously it's a little different than just saying, okay, put a submission out, here's 5 quotes, let's take the cheapest one. So you do need to understand sort of the variability component to it. But there is variability in guaranteed cost. It's kind of like the old retro deals, right? So I write a deal this year, all the losses flow through, so I'm still going to be paying for those losses, going forward. Guaranteed cost is the ultimate retro. If you burn the market this year, you're going to absolutely be, trying to recoup that lost premium based on those losses that they paid out over multiple renewals. So again, as I say, it's an old adage, but there's no free lunch in this world, particularly in the insurance game.
Well, thanks, Craig. I like to keep these videos rather tight, and hopefully people that are interested can reach out to me or directly to you and get more specific information. So I will be posting your one pager with your contact information, and then certainly we can direct these to to the appropriate people. So thank you, Craig, for your time. Was there anything else that you'd wanted to add before we conclude?
No, Sean, I think again, it's something that it's like how do you eat an elephant? It's like one small bite at a time. So again, I think that's good.
I like it.